Hello, everybody. All right, so today I'm going to be focusing on like probably one of the most important skills in trading, which is thinking in probabilities and how it's done. Probabilities. All right. All right. So this is extremely important, and without this, you just can't trade. Without this, what happens is there's a lot of tilt. All right, so thinking in probabilities is a foundational requirement, especially for active traders. You cannot trade without this. Without this, there will be tilt, there will be anger, there will be all types of emotions. So professional traders have figured this out, and they know that's how their mind thinks. So now, when it comes to thinking probabilities, many people think, okay, it's just a win-loss rate, meaning I have a quote-unquote setup, and it has I don't know, 60% win and 35% loss. So 65% win, 35% loss, right? This is what most people will think, that this is thinking probabilities. That's incorrect. This is not thinking in probabilities, meaning having wins and losses, and okay, this is the wins and this is the losses. I mean, this is a real oversimplification. All right? What thinking in probabilities is understanding that every variable in trading has a distribution. Okay, has multiple possibilities. That's what I mean by distribution. And now practically, what does this mean? What does this mean? That every variable in trading has a distribution. So I'll give you an example, and through those examples, you'll see what it means. So let's say, the market does this, and then you have a really nice impulsive move or breakout, and you want to buy the pullback. So so depending on how you buy pullbacks, there will be folks that will want to do what? They'll buy the test of the breakout, right? That's one possibility. They'll be buying here. Why? Because they think it's going to do this, and it's going to then make a high, a measured move target or whatever. Other possibility is the market, after it breaks out, it goes all the way back to a demand zone with a much bigger pullback right here. And then they think it's going to do whatever it does and then break out. All right. Third possibility is that it doesn't go here or there, but it goes somewhere in the middle. Why? Because there's a POC there. There's a POC here. So volume-based support. All right. So the thing, because there's a POC there, they're going. Some traders will look to buy near the demand POC. Right. So here, this is one possibility where you have test of breakout, right, or what they say creep. Over here, you have a pullback all the way down to a demand zone. And here you have a pullback all the way to the POC. And then reversal. Now, even within this, so these are just three possibilities. These are all valid ways of entering. Right? So you see, and they're all used, heavily used. All right? So you got one guy here buying the pullback of the breakout. And I mean, there's actually a very popular fourth method, which is, it goes up here, does that, and then they'll buy the golden zone or whatever that is, 68%, based on price, amount of pullback, right? So they'll just buy something like that. So you have already four entry approaches: the test of the breakout, the demand zone, the pullback to a POC level, or a Fibonacci retracement. These are four very common methods of entry, right? So already, when it comes to entry, there is variability. Four major approaches, okay? And that's, considering it works, we don't know yet. It's just four approaches to entry. And there are others. As soon as it comes back here, for example, we might have something like this. Someone wants a spring, that ABC correction. And they'll buy it as soon as the market dips below and comes right back above. So A, B, C, and break above A. So this is the fourth one. So already you see multiple entry methods, multiple things that come to mind, right? So we don't know which one the market will respect, A, B, C, D, or E. Will it respond off creek? Will it respond off this? Will the creek then be retested as a spring? Will there be a demand zone? Will it pull back to POC? We don't know which one. We just don't know which one it's going to be. All right, so entry has all of these possibilities. So exits, similarly, right? So, it's just so many. Let's just, any one of these entries, like let's say it goes up, down, breaks out, pulls back, and, the guy buys somewhere here, and you're targeting a new swing high. You're targeting, what did I do? You're targeting, let's just say a measured move, all right? So make it simple. Up, down, up, measured move. So A, B equals C, D, all right? Let's say you're targeting that. That's one possibility. Second possibility is that the market only goes to resistance and it fails. It comes back right back down. It only goes to resistance and it stops. Another possibility is the market does break out, but there's no follow-through. So it doesn't complete the measured move. It does not complete the measured move. It just makes a new high and comes all the way back. Right? So the first one was the hopes and dreams of that measured move. The nice big target. The other just went to resistance and pulled back. And the third one, it hit the new high, did not go all the way to the measured move, and then pulled back. Right? And of course, you have situations where you have it goes beyond the measured move and just goes becomes a runner. So one is measured move, two is resistance, third is the breakout, fourth is breakout and runner. So we see the entry possibilities. There's multiple entry possibilities. there are multiple exit possibilities, and I've only identified the major categories. I'm not even, it's impossible to get every situation. These are just the categories, nothing more than the categories. The Forex traders will look to buy the demand zone and look to get out at the new high. That's what they do. The momentum traders will look to get in on a pullback, probably to something like this. Goes here, then they get their pullback to a 10 MA, where they're looking for a reversal or some engulfing bar or whatever, or a level 2, and then they're looking. This is a sixth way of entry, certain types of stocks, etc. Right? So you see all of these entry possibilities, you see all of the exit possibilities, and markets will dynamically move, randomly select. This pullback might be a test of the breakout. That pullback might go all the way down to the demand zone. Another pullback might go to the POC. You just don't know which one's going to work. You just don't know which one is going to work. Not which one's going to work, but which one is going to happen. And if you are in, you don't know whether, for example, let's say you got in on the test of the breakout. Right? You got in the test of breakout. What do you think is going to happen in the spring? You get shaken out, or you get stopped out. So you don't know if that's going to happen. So you have multiple, or whatever entry at MA, whatever, 14, 10, some use 20. All right. So every variable in trading has a distribution. The entries have by distribution among multiple possibilities. So the entry can be this, right? And the exits can also be multiple. Right? So you can see entries have multiple possibilities, exits have multiple possibilities, and that's if they work. If they work, right? So this is what thinking in possibilities is. It's accepting that what you're learning in the books. I'll give you one example. All right, let's say a point and figure target, right? All right. So we know that you should have a cause, all right? It's said in Wyckoff that you should have a cause. And then it's just a potential to go, all right, to a particular target. It's just a potential and a possibility. That's why it's taken off the, various levels. But even when Wyckoff does it, he keeps getting new targets on every stepping stone count and all of that, right? So, and you see many practitioners, they'll do it from the low as well. They'll do it from the low as well as the last point of support or last point of supply. There's no way to figure out which one's going to get hit, if it gets hit at all. So all these X's and O's, it may not work. All right, so it's just a potential target. Just like the measured move is a potential target, because you need something as part of your execution procedure. Otherwise, you're totally in the dark, and basically you'll make an emotional decision. So this is what I mean. There is no such thing as, let's use the potential, saying, okay, the count here from this $10 area is 5, so it's going to go to $15. Right? How do you know? It may go to 13 base out and then go to 20. You don't really know. Okay? So that's the important thing to understand. Many times it will just go to a weekly level, right? So you have a weekly high, it just goes and takes out the weekly high and then stops right there and reverses. So this is what I'm trying to say. Thinking in probabilities must be the foundation of your execution. How is it the foundation of your execution? This is the next part. All right. So how is thinking in probabilities foundational to execution? Meaning, how do you practically use it? Right. So how do you practically use it? First, let me say, how do you not use it? Okay. How traders will shoot themselves in the foot. Traders shoot themselves in the foot when one second. So traders shoot themselves in the foot or make errors when specifically, let's say they get in, let's say this guy got in right here, okay, and then he's just putting his entire exit at measured move or a pretty high target. So he's not going to scale out. He's just going to exit everything at this particular point. All right. So he got in. It reversed. His stop was right here. And his target is right here. Do you know how many times the market will give him profit? All of this profit, we're talking about like whatever his target was, how many times the market will give him at least half of it and then reverse. But instead of taking out any profit from the market, he basically had a loss. Instead of saying, let's say he had a $1,000 target per contract, instead of taking the 500 or something at the 500 mark, he took nothing. And what happened was the market reversed, and then it broke the low, stopped him out, and went into a demand zone, and then it went to the target. So this guy got in at the break of the test of the breakout. He's in. It goes to resistance, breaks out. He doesn't take anything back. It doesn't take any profit. He's waiting for the target. Goes to sleep. In the morning, he sees himself stopped out. Price goes down to demand zone, but these guys get filled, and price goes to the target that he wanted it to go to, and he doesn't take a damn thing out of the trade. He doesn't take even 500, even though he had 500. He could have scaled out half the position or at least a third of the position, but he doesn't. So this is the problem. All right. And this, I'm saying this because this is not a fictitious scenario. It happens to everyone. It happens to me like so many times. I can't tell you. So that's why I learned. so the thinking in probabilities is planning in advance in your execution procedure for different possibilities. Meaning your execution procedure says, you know what? I'm going to get in here, but I understand that it may not work out. That's the first thing you have to consider. That this may not meet my expectations and go to a particular target. So I will plan for that in advance. As part of my execution procedure, I will plan for that in advance. Meaning, plan for your expectations to not be met. Plan for your expectations as, in a way, saying that I actually expect the unexpected, and I plan for it. I expect the unexpected, and I plan for it. That means that if I have a big target, I'm not going to wait for it to go to only that one price. It may go beyond it, and may go below it, and it may reverse, and it may go to a lower level on a time frame I am not even looking at. It may go to that weekly area, take out the weekly low or the high, and then do what I think it's going to do. So you have to expect the unexpected. That's really thinking in probabilities, and plan for it in your execution procedure. So every trade you prepare for the unexpected. One unexpected possibility is it doesn't work out, you get stopped out. The other one is that it works out, but only a little bit. Meaning, instead of a $1,000 target, you might only go to $333. It may go to $500. And finally, it may work as you think it was supposed to work, and it may even do better. So all of that needs to be considered in your execution procedure. That's thinking in probabilities. So you see how much more of a skill it is than just taking a trade setup and saying, oh, this is a 65% winner, or this is an 80% winner, or this is a 35 to 50% winner. That is not telling you how to execute, because every one of those winners, right, will have random entries and exits. So someone says, okay, this is I don't know, 70% winner, right? How many of those winners did you enter the test of the breakout versus the demand zone as the best point of entry? How many of those winners when they pulled back for an entry, the entry was here or at the POC, or was just as a Fibonacci level, or just at a moving average that didn't coincide with any of this? Those 65, 75, 70% winners are not telling you the entry, because all those entries fit in different categories. Some of those winners pulled back to test the breakout where there was an entry. Some of those winners pulled back all the way to the demand zone when there were entries. Some of them went to the POC. Some of them just didn't even pull back. It was a very, very light pullback. Or some of them you had to enter on the breakout. Or some of them you just had to enter on the next green bar, because they had a lot of momentum. And there was no category to classify them. You see, so 65% winners, someone may say, oh, the way you would enter this for these all 65% is on a pullback to the halfway back area, that 50% back area. If that's the case, can you tell me how much risk was for each one of those trades? I guarantee you they'll be flabbergasted, because 50%, you have a market that does this, and it's 50%, and you have all this risk, and you have a market that does this, and it's a 50% pullback, and it's a little bit of risk. 50% can be $1,000 risk, 50% can be $350 risk. So that's a big difference. So obviously you're not going to trade every 50%. because the risk of 50% is not always the same amount. 50% is a percentage of something. That could be a really big move. So that's why those things are not, it's just not practical to think like that. Anyway, so this is thinking in probabilities for entry, understanding that you have various degrees, various classifications of entry at different levels, different categories at MA, at 68. Yeah. Now that doesn't mean that you trade all of them. It doesn't mean you trade all of them. You pick what you're really good at. All right, so I want to make this clear. You pick what you're really, really, really good at, because if you chase this, it can never lead to consistency and it can never lead to profitability. It's just being aware that anything can happen, or any one of these situations can happen for the pullback. It can be a 68, it can be a demand zone, it can be a spring, it can be ABC correction, it can be a POC. Understanding any one of these, but given anything, you select one thing that you're really good at. Okay, and believe me, you'll have a natural inclination to some folks. They will be the Forex, for example. Those guys will be all over the demand and supply zone type of trading. Wyckoff traders, they'll be looking at that test of the breakout, or the spring at the breakout. Momentum traders will be all about getting that pullback, and some order flow traders will be all about seeing their level 2 and time and sales and a big order, and it'll be all about that, right? But you gotta pick one and really refine it, okay, so you can create some type of consistency. All right, that's one. Now, of these entries, so I'm not going to go into edge because there's just too many, but the idea is the same, like all of that. So the exits, does this mean for the exit you pick one? And I don't mean like just pick one. For the entries, you can have one or two. It's just what I'm trying to say is you can't trade every entry. What you may have one, or you may have two. For example, you may trade a spring and the test of the breakout, or you may trade the demand zone and the POC, or you may trade a stock trader looking for momentum. It's going to be all over that moving average and key reversal, or some other stock traders will be all about that 68%. So you might have Forex traders that use 68% in the demand zone or whatever. But basically you specialize in one or two entries. And now for the exit, it's the same. But you don't always put your exit at one place. Okay, I'm going to enter here. Market is going to make a new high on the 4 hour, and I'm going to get out there. You're in fucking la la land, all right? Because those are pretty big trades. And if you think you're going to get a 15-minute entry right here, and it's going to go all the way up to the 4 hour, and I'm going to take, my what is it, 30 to 1 or 20 to 1 trade, and that's the only, what if it only goes to 9 or 10 to 1 and you're not going to take any profit? I mean, you're fucking crazy, right? So the idea here is to scale out, meaning at least two exits, or at least consider instead of, the market is going to do this because I read it in a book or watched the supply and demand YouTube video. Ask yourself, what if it doesn't? What if the market doesn't go to the new high? Do I have a backup plan for that? What if it doesn't hit my 1 to 20? Shouldn't I take something off at a 3R? Shouldn't I take something off at a 3R a little bit? maybe a third, instead of hoping and dreaming that it'll go to my 15 to 20 hour trade? Shouldn't I take a little bit? So if you think in probabilities, you will take something off at a lower target, at least 2 exits, at least 2 exits. So what am I saying here? You have a happy scenario and not a happy scenario, but a what if it doesn't scenario. Okay? And these are the two, at least 2 exits. You can use 3 as well. Like, you know, you could have one at the, as soon as you enter, you could have one at a predetermined amount. You could have one at the supply zone before the breakout, and then one at the breakout, new high. Or even if you have 4, the 4th one could be a runner, and you could do a trail on it. So the point is at least 2. Just anything more than just your happy scenario that, this is what's going to happen, because that's where you fuck up. And for the entry, the same. You know, just have an approach. So pick whichever entry, creating consistency with an entry. With with 1 or 2 entry approaches. 1 or 2 entry approaches. Okay? And then at least 2 exits. You know? The happy scenario and the unhappy, or what if it doesn't scenario. At least 2 exits and up to 1 to 2 entries. If you take more than that, I don't know what's going to happen. It's going to just have a lot of distribution. A lot of shit just won't work. It just won't work. Okay, so that's the situation. All right, so this is what thinking in probabilities, putting that in your execution means. The entry, the exit, as far as edge is concerned, that is a tricky thing, because most people, I think it's not I take that back. Most people, that's what they spend 80% of the time on, so they'll already have it figured out. Someone will have this system or that system. So the edge part, that's where all the effort goes. All of the effort goes to identifying the edge. So some traders will use a breakout, and they look for volume on the breakout, which is confirmed by, like, say, the 5 major stocks. Is Apple going? Yes. Is NASDAQ going? Yes. Is the XLK going? Yeah. All of that. So they will take whatever edge they use. So one will use breakout, one will use pullback, and then they'll say something like, okay, if it's there, does it have a big wick? Is it a pin bar? Is it a key reversal bar, or whatever? It's this number of edges. So just select 1 or 2, have a consistent entry approach, 1 or 2, most likely 1 you'll be really good at, and just work on that. And then exits, you gotta have more than 1, no doubt about it. So 1 edge, 1 entry, 1 to 2 max, and then at least 2 exits. This is my fucking TradeStation. All the time it gives me this error. I don't know what this is. But anyway, coming back to this, where am I? Okay, so you have the entry, you have the exits, you have all this. All right, so this is what thinking in probabilities is within trading, and this is extremely important to have this at the root of whatever it is that you do in trading, because you have to say that I expect the unexpected and I plan for it already. If you do that, the chances of blowing the account are very, I don't think it's possible, because you already planned, and hopefully you don't tilt. So even if you have losses in a row, you don't tilt and take a massive loss, because you've already accepted the possibility of this not working out in advance, instead of trying to fight it and not accept that it's not working out. You've already accepted the possibility of this trade not doing what it's quote unquote supposed to do, and plan for it, and have very low risk. All right, so that's the thing. Other thing is, as far as trading losses are concerned, you'll see that most of them are they have to do with constant change, and I'll talk about this later. But constant change, this is, if you're constantly changing, that means that you haven't accepted, like let's say if you go from one methodology to another methodology, this approach, that approach, chances are you haven't accepted thinking in probabilities, because you see that one thing quote unquote didn't work, so you go into the other, not realizing that also there will be times when it doesn't work. And the third thing that you go to, there will also be times when it doesn't work. So everything has a probabilistic, like I show here, every methodology has a probabilistic, because that's what trading is. Okay, so constant change and losses typically come from not thinking in probabilities, and therefore fighting, and also from change. Change is you have to be settled, right, with your approach. If it's not settled, you shouldn't be trading. You shouldn't be an exploratory activity while you're trading. You should have done the exploration already, stop, and then keep consistent, and then trade, planning for unmet expectations and all of that. All right, that's all, folks. Thanks. Bye.